December 11th, 2025. Silver exploded to $63.58, then rocketed past $64 before pulling back. This is a 115% surge since January. You know what else happened when silver moved like this? October 1980, the Hunt brothers controlled 200 million ounces, and silver hit $49 before the exchange changed the rules overnight. In the next 13 minutes, I'm going to show you 4 institutional indicators that tell us exactly when this situation intensifies, the volt drain data that has analysts calling this an emergency, and why the December 18th FOMC decision, plus the December 26th contract expiration, will determine if we see 70 tolerance or a violent correction. I'm not a financial advisor, and this isn't financial advice. But according to publicly available data from independent market analysts, over 47.6 million ounces of silver were claimed for delivery in the first 4 trading days of December 2025. That's more than 60% of COMEX's total registered inventory in just 4 days. Normal daily drains in 2024 averaged 200,000 ounces. We're talking about a withdrawal rate 238 times faster than historical patterns. Let me show you what's happening beneath the surface. Every major commodity squeeze follows the same pattern, not similar, identical. 4 stages that have repeated throughout history. Stage 1. Dependency. The global economy becomes structurally reliant on a stable supply. Silver isn't just jewelry and coins anymore. It's in every smartphone, every solar panel, every electric vehicle battery. The world needs 1.2 billion ounces annually, but primary mine production delivers only 820 million ounces. The 380 million ounce deficit gets filled by recycling and above-ground stockpiles. Stage 2. Weaponization. Supply gets restricted, either by governments or market mechanics. In 2025, we've seen both. China announced export controls on antimony and gallium in September. Silver didn't make the list officially, but lease rates spiked 5 times this year as physical metal became harder to borrow. The message was clear. Access to critical industrial metals is now a geopolitical lever. Stage 3. Crisis. Prices surge, physical metal vanishes from wholesale markets, and panic buying overwhelms the system. Look at what happened between December 4th and 8th. Over 47 million ounces claimed for delivery. Shanghai silver inventories dropped below 446 tons, the lowest since 2016. Lease rates hit 35%, annualized in October, before settling around 24% in early December. That's not a market. That's a scramble. Stage 4. Realignment. The market structure breaks, and a new order emerges. Either COMEX shifts to cash settlements as they did in 1980, or physical silver decouples from paper futures and trades at massive premiums. We're watching this play out in real time. This happened in 1980 with silver. It happened in 2001 with palladium when Russia delayed shipments. It happened in 2020 when palladium hit $12,800 in 8 weeks on supply fears. Right now, silver is deep in stage 3, testing whether stage 4 breaks the system. Let me prove it. Here's what analysts are missing. The data isn't just concerning, it's unambiguous. Current prices. As of December 11th, 2025, silver traded at $63.58 per ounce in morning sessions, up 2.90% from the previous day. Over the past month, silver surged 19.34%. Year to date, the gain is 105.78%. That's not a rally, that's a structural repricing. Trading Economics confirmed these figures as of December 11th. The all-time high was 61.94 on December 10th, breaking the 45-year record of 49.95 set on January 17th, 1980. To put this in perspective, your grandfather's generation saw silver hit 50 in 1980. After 45 years of inflation, economic growth, and technological revolution, we only just surpassed that level. Silver has been historically suppressed, and the market is correcting violently. COMEX inventory crisis. According to independent market reports analyzing CME data, COMEX registered silver inventory has been decimated. Over 47.6 million ounces were claimed for physical delivery in just 4 trading days starting December 4th. That represents more than 60% of COMEX's total registered inventory. When you drain 60% of the available supply in 4 days, you're not looking at normal market function. You're looking at a systemic breakdown. Historical context. In 2024, daily drains averaged 200,000 ounces. Between December 4th and 8th, we averaged 11.9 million ounces per day. That's 59 times the normal rate, not 2 times or 5 times, 59 times. Since 2020, COMEX vault inventories have declined by over 73%. The pool that backs futures contracts is evaporating. You can verify these trends by checking independent commodity market analysis reports covering COMEX vault movements. The data is consistent across multiple analytical sources. Lease rates explosion. Silver lease rates are the cost of borrowing physical metal from bullion holders. When lease rates spike, it means physical silver is scarce, and demand to borrow it is desperate. According to market data compiled by Bullion Vault, 1-month silver lease rates hit 19% annualized in October, then spiked to 35% as silver prices touched new all-time highs above $50 per ounce. As of early December, they remain elevated around 24%. Historical precedent: lease rates above 30% are unprecedented. This is the 5th time in 2025 that lease rates spiked. Bruce Ikemizu, former Tokyo Precious Metals banking director and current head of the Japan Bullion Market Association, declared, "Silver squeeze is on. This is serious." When institutional insiders with decades of experience issue warnings like that, you pay attention. Bernard Dada, precious metals analyst at Natixis, explained that silver's go-forward rate reached negative territory around 1.2% in September. In layman's terms, the party borrowing silver was willing to pay interest rather than earn it. That's market dislocation. You can find these lease rate analyses through precious metals market research published by institutional commodity desks. Federal Reserve decision impact. On December 10th, the Federal Reserve cut its key interest rate by 25 basis points to a range of 3.5% to 3.75%. This was the 3rd consecutive cut. The decision drew 3 dissents, the most division since 2019. Fed Chair Jerome Powell signaled only 1 additional cut expected in 2026, creating uncertainty about future policy. Here's why this matters for silver. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. When Treasury yields fall, metals become more attractive. Powell's comments suggested the Fed is approaching a pause, which created a dovish interpretation. The dollar weakened 0.63% on December 10th, making dollar-denominated commodities cheaper for foreign buyers. This amplified physical demand, particularly from Asia. Shanghai. Premium signals. Shanghai Gold Exchange silver premiums have been fluctuating significantly. According to trading data, when Shanghai premiums consistently exceed 2% above London spot, it indicates strong Asian physical demand overwhelming supply. Reports in 2025 showed Shanghai silver inventories hit decade lows, dropping below 446 tons with over 300 tons lost in October alone. The mechanism is simple. When Chinese buyers pay premiums over international spot prices, they're signaling domestic supply shortages. Silver flows east, depleting Western vaults. This creates a feedback loop where COMEX must source metal from shrinking global stockpiles. ETF flows. The iShares Silver Trust, SLV, the largest silver ETF, has seen massive inflows. As of December 11th, SLV traded at $57.39, up 2.36% from the previous day. Year-to-date return, 110.20%. According to ETF flow data, SLV recorded net inflows of $207 million in the past 5 days, $1.51 billion over 1 month, and $2.04 billion over 1 year. Assets under management reached approximately $29.32 billion as of early December. When institutional money pours into silver ETFs at this pace, it removes physical metal from the market. SLV must buy actual silver to back shares. That creates additional physical demand on top of industrial and investment buying. You can verify SLV holdings and flows through the iShares website and financial data providers. Backwardation. Breakdown. Backwardation occurs when spot prices trade above futures prices. It's the opposite of a normal market structure. In a healthy commodity market, futures trade at a premium to spot, contango, because of storage and financing costs. When backwardation emerges, it signals extreme physical tightness. According to market reports, silver futures exhibited backwardation at various points in 2025, with spot trading up to 60 cents per ounce above futures. Some contracts showed backwardation spreads reaching $3,000 per contract. December COMEX. Silver futures traded 1 ton lower than London spot prices as of recent data. Wholesale bullion was more expensive than exchange futures. The kicker: backwardation destroys the carry trade. Normally, traders can buy spot, sell futures, and lock in a risk-free profit. When that flips, it means nobody believes futures will deliver physical metal. The paper market is breaking, but here's what changes everything. I'm personally tracking 4 indicators on a daily basis. These tell me everything about what happens next. The moment we hit critical thresholds, you'll know exactly which scenario is unfolding. Indicator 1. COMEX. Registered inventory. Current. Reading. Reported analyses suggest inventory declined from 48 million to approximately 19 million ounces through early December. Critical threshold. Sub 15 million ounces. What it means: below 15 million, we enter uncharted territory where delivery demands could exceed available supply for the December contract expiration on December 26th. Where to track: CME Group Vault reports, updated daily on the CME website under the precious metals sections. Indicator 2. Silver lease rates, 1 month. Current reading: approximately 24% annualized as of early December, down from 35% peak in October. Critical threshold: above 40–50%, sustained for 5+ business days. What it means: lease rates above 40% signal acute physical scarcity. No one can borrow metal at any reasonable cost. That precedes either a price explosion or market rule changes. Where to track: LBMA data, precious metals dealers, and institutional commodity research reports. Indicator 3. Backwardation duration. Current reading: intermittent backwardation with spot trading above March futures by variable amounts. Critical threshold: spot trading above 3-month futures for 5+ consecutive days. What it means: sustained backwardation for a full week means the paper market has lost credibility. Physical holders refuse to sell forward, anticipating higher prices or questioning futures delivery. Where to track: futures price curves on CME, commodity trading platforms. Indicator 4. Shanghai premium current reading. Shanghai inventories at decade lows, premiums fluctuating. Critical threshold: sustained premiums above 5% for 2+ weeks. What it means: a 5% premium sustained over 2 weeks indicates China is vacuum cleaning global supply. Western vaults drain to feed Eastern demand, accelerating the squeeze. Where to track: Shanghai Gold Exchange data, international arbitrage reports. Watch what happens when these align. In February 2020, palladium hit all 4 threshold signals simultaneously. Price rocketed from $1,500 to $2,800 in 8 weeks. In October 1980, silver lease rates spiked, inventories collapsed, and the Hunt brothers controlled physical supply. Silver went from 6 to 49 in 12 months before COMEX changed the rules on January 7, 1980, with Silver Rule 7. Let me show you what happened the last time we saw this exact pattern. The Hunt brothers silver squeeze, 1980–1979. Nelson Bunker Hunt and his brother Willie accumulated 200 million ounces of silver. Their bet was simple: the dollar is dying, fiat currency is collapsing, and silver is real money. They were Texas oil billionaires who believed inflation would destroy paper wealth. January 1979, $6 per ounce. January 17, 1980, $49.45. That's 724% in 12 months. The Hunts didn't just buy futures, they took delivery. They drained the vaults. Sound familiar? Then COMEX changed the rules. January 7, 1980. Silver Rule 7 was implemented. No more long positions allowed. You could sell silver. You could maintain existing positions, but you could not buy. The exchange unilaterally altered the terms to break the squeeze. March 27, 1980. Silver Thursday. Price collapses from $21 to $10.80 in one day. The Hunts lose $1.7 billion and declare bankruptcy. Their empire crumbles. But here's what everyone forgets. People holding physical silver, not futures, not paper, actual metal in their possession. They didn't lose anything. When the dust settled, silver was $10. That's still 66% higher than where it started in 1979. The lesson: you can't change the rules on something you actually own. If you held physical, the rule change didn't affect you. If you held paper contracts, you got crushed when the exchange shifted to cash settlement. Palladium squeeze, 2001. Russia controls 60% of the global palladium supply. They mysteriously delay shipments. No official announcement. Just administrative complications. For months, the metal simply doesn't show up. Physical metal vanishes from markets. Automakers panic because they need palladium for catalytic converters. There's no substitute at the price point. Price spikes 263% over 2 years. Paper traders holding futures got crushed when there was no metal to deliver. People holding physical metal became very, very rich. When the physical market decouples from the paper market, physical wins. Same pattern. Same outcome. The provocative question, I think, needs asking. What happens next? Based on CME data, Federal Reserve policy trajectory, and historical commodity squeeze patterns, I see 3 paths. Here's the probability breakdown and the exact signals that tell us which path we're taking. Scenario 1. The parabolic squeeze, 25% probability. Timeline: January-April 2026. Price target: $80-$95. Trigger condition: COMEX. Registered inventory falls below 15 million ounces, or 3 consecutive weeks of 2 million plus ounce daily drains. Confirmation signal: Shanghai premiums sustain above 5%, and lease rates spike above 40% simultaneously. Historical parallel: Palladium. February 2020, $1,500, $2,800 in 8 weeks. Current status: at reported data 19 million ounces, we're 4 million away from the trigger zone. Scenario 2. The measured grind, 50% probability, my base case. Timeline: December 2025, June 2026. Price target: $68-$78 with consolidation periods. Trigger condition: December 26th. Contract expiration forces short covering but doesn't break the system. Confirmation signal: inventory stabilizes between 20 to 25 million ounces with sustained trading above $60. Historical parallel. Gold, 2019-2020. Steady climb from $1,400 to $2,000. Current status: December expiration is 14 days away. Critical window approaching. Scenario 3. The rule change correction, 25% probability. Timeline: peaks within 45 days, corrects Q1 2026. Price target: peak $68.72s, then back to $48.55. Trigger condition: COMEX announces position limits or forced cash settlement, like the 1980 Silver Rule 7. Confirmation signal: exchange rule announcement, plus Shanghai premiums collapse below London spot. Historical parallel: Silver 1980, post-Rule 7 correction. Current status: would require exchange intervention to activate this path. Right now, December 12th conditions show inventory reportedly around 19 million, declining rapidly. Lease rates elevated at 24%, historically high but off-peak. Intermittent backwardation, a warning signal. Fed dovish but cautious, supportive for metals. We're tracking Scenario 2, with Scenario 1 risk increasing daily. The key decision point: December 18th, FOMC decision, and December 26th, COMEX contract expiration. Those 2 dates determine whether we get a measured rally or a parabolic melt-up. You might be thinking, I don't invest in silver, why does this affect me? Because silver is embedded in your daily life, this squeeze will hit your wallet regardless. Your smartphone contains 0.5 grams of silver. Electric vehicles use 25 to 50 grams per car, double what combustion engines require. Solar panels use 20 grams each. The solar industry alone consumes 232 million ounces annually, 16% of global demand, growing 14% per year. AI data centers run on servers with silver-coated components. ChatGPT's infrastructure uses millions of ounces. If scenario 1 plays out and we hit $95 silver, here's what changes. First, phone prices rise 12 to 18% within 6 months as manufacturers absorb higher component costs. Second, solar installation delays stretch to 18-24 months as panel production faces supply constraints. Third, your electricity bill increases as utilities pay premiums for grid infrastructure that requires silver. This isn't abstract economic theory. On January 1st, China's antimony export controls take full effect. December 26th, the COMEX December contract expires. That's 14 and 19 days away. Here's what you need to do right now. First, monitor the 4 indicators I gave you. Check COMEX Vault reports weekly. When registered inventory breaks below 15 million ounces, that's your signal that scenario 1 is activating. Set calendar reminders for Monday and Thursday Vault data releases. Second, watch the December 18th FOMC meeting and the December 26th COMEX contract expiration. December 18th determines whether the Fed pauses or continues cutting, affecting dollar strength and metal prices. December 26th determines whether shorts can deliver physical or must cash settle. Those dates are critical inflection points. Third, understand the difference between paper and physical. This matters when markets get dislocated. In 1980, paper traders got destroyed when COMEX changed the rules. Physical holders kept their metal. The same pattern played out with palladium in 2001. When supply vanishes, physical and paper decouple. The next 30 days will determine whether we get a measured grind to $68.78 or a parabolic squeeze to $80.95. I'm tracking these 4 indicators daily: COMEX inventory, lease rates, backwardation, and Shanghai premiums. The moment we hit critical thresholds across multiple indicators simultaneously, I'm releasing an emergency update within 4 hours. You'll miss it unless you're subscribed with notifications turned on. Drop a comment. Which indicator do you think breaks first? I'll share what historical patterns suggest happens when that specific signal triggers. I read every comment and respond within 24 hours. See you in the next breakdown.